everyone, and thank you so much for joining us today for one of our weekly Chevron related webinars. I'm Sam and I moderate these presentations, and in just a second we will be joined by our senior financial advisor Tyson Mavar, who's going to be covering whether to take the lump sum or the annuity option when you decide to retire from Chevron. First and foremost, though, just a couple housekeeping items to go over with you. First, we are not affiliated nor endorsed whatsoever by Chevron. We are a completely independent group of financial advisors, so please keep that in mind as you're listening along. Second, while Tyson is speaking, you will see me entering some links. Those are going to pop up on your screen there, unless you're watching on YouTube. In that case, there will be some links in the description box that you can click on, and those will guide you to our calendar where you can book a free consultation. It is a 15-minute block of time to speak to one of our Chevron-focused advisors about your specific concerns or situation, so I encourage you to take advantage of that. You can also follow us here on YouTube. You can follow us on LinkedIn. We post tons of Chevron-related content weekly, and we really think you'd get some value out of it if you considered giving us a follow. And with all of that out of the way now, we're going to get started with Tyson Mavar.
Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mavar, one of the Chevron-focused retirement advisors here at Wealth Enhancement Group. Today's webinar series, we're going to be talking about specifically the Chevron pension plan. We have a lot of clients and prospective clients have been calling for information on the benefits plans based on this reduction in workforce that's happening this year. Some of our clients ended up raising their hand to be considered for the first wave of the EOI. We expect those folks to hear whether or not they were accepted for this on March 24th, I believe. We're also expecting some involuntary layoffs to happen later in the year. I believe it's going to be at the end of June is when it's projected for. And I've been told there's going to be a second wave of the EOI, and I'm not certain whether that's before or after layoffs, but my gut tells me it'll probably be before layoffs, which will have likely different off-payroll dates compared to the folks that took the first wave of the EOI. There's just a lot going on right now. So today we're going to focus on some of the important issues on the Chevron pension plan. Here's just a list of some of the major companies in the U.S. that have reduced headcount, Chevron being by far the biggest announcement as they look to reduce global headcount by 15 to 20% by the end of the year. And we expect more companies to announce this with slowdowns happening, not just in oil and gas, but in a lot of different industries. And you all are in the thick of this right now. This expression of interest, we saw this back in 2016 with what they called the ROM, or Resource Optimization Management, back in 2020 and 2021 with the last EOI. And this year, where the company's effectively looking to reorganize the company and reduce headcount. They typically have done this about every 4 to 5 years, as long as I've been working with Chevron employees. And the goal is to minimize how many involuntary separations they have to go through this year. So they're going to give some folks, especially folks that are close to retirement anyway, an option to leave the company and get a pretty healthy severance package for most people, and some health benefits as well, some COBRA continuation coverage, which will reduce healthcare costs post Chevron. And unfortunately, there's going to be a lot of people that will have to leave payroll that weren't necessarily planning to, and this is what we want to be a resource for this year, especially for the folks that are going to be probably looking for another job later this year or maybe next year, depending on how long that severance package lasts. We want to be a resource to you on your benefit options as well as your financial plan. Most mistakes that we see made are in terms of taxes and the implementation of your tax strategy when pulling your pension out, pulling your 401k out. We also see people not understanding all their options on the pension plan. So we're going to focus on that directly today. Here's some questions we'd like you to consider though. Are you ready to retire psychologically? And a lot of people don't think too much about retirement just because we get so caught up in our jobs and planning vacations, what's going on with our family, and retirement sort of falls down that priority list. So becoming psychologically prepared to retire is a big deal, or psychologically prepared to leave Chevron and change jobs. That comes with a lot of work of getting your resume out there, going through the learning curve at the new company and maybe new industry. So getting psychologically ready is a big deal. But there's also the financial readiness. Can you afford to retire? And if not now, when can you afford to retire? When's going to be the best time to retire? And you might not necessarily have an optimal retirement plan after leaving Chevron. So you might want to consider some part-time or full-time work. We're here to help you identify if you need to do that, and if so, how long do you need to work? How much do you need to target in terms of a salary to get where your retirement plan needs to be fully sustainable to last at least the rest of your life? And how does the pension and 401k or Chevron retirement plan and employee savings investment plan play a role into your retirement strategy? We're going to talk about the pension today, but the 401k, you have a lot of great options while you're working, and even better options after you leave the company, as they no longer require you to keep that money in the plan that has rather limited investment options. So that's something we work with a lot of people. In fact, we manage retirement assets for Chevron employees. We have a lot of clients from Chevron going back over 20 years now. And we feel that we are very well positioned to help people successfully transition out of the company, avoid some of the most common mistakes. And our hope is that you consider becoming a client of ours and maybe have a lifelong relationship with us, although that's certainly not an expectation if you decide to spend a few minutes with us and go through your retirement plan. If you have LTIPs, long-term incentive plan, there's going to be some tax implications there and potentially some decisions about how to use those in your retirement plan, especially with the stock option. So we're delighted to talk to you about and help you with those as well. And then also health insurance. That's one of the biggest concerns I hear from people is, what are my options on health insurance? If you don't have your full 90 points of age and service with the company, you're not going to get the full subsidy, although you might still have a decent subsidy to stay on the Chevron plan. We want to compare that to other options you might have, whether it's a spouse's plan, active employer retirement plan, maybe the state exchanges, looking at those. Maybe that's, if you're going back to work after Chevron, something you want to be looking at for the companies you work for is how lucrative is their health plan. And that might be something, if you don't need a health plan but plan on going back to work, you could do some consulting or contract work where you don't require health insurance and can maybe negotiate a better salary as a result of not needing health insurance. And what is your overall retirement plan? This is where we come in and put together this cash flow analysis to start to determine what strategy is going to allow your money to last the longest. Big part of that is taxes, but also the timing on taking your benefits, especially with the pension, which we'll talk about in a moment. So the pension with Chevron, it's dependent on when you started with the company. So if you started on or after January 1st, 2008, you're going to be on a cash balance plan where your lump sum is not going to be a function of interest rate changes. Meaning that when interest rates go up, your lump sum is not going to go down if you're on the cash balance plan. But if you're on one of the defined benefit plans, whether you came from Gulf, Texaco, Heritage Chevron, Unocal, Getty, any of the heritage companies, your defined benefit plan is going to be calculated as a single life annuity and then converted into either a lump sum or one of these other various annuity options that we'll talk about in just a moment here. The normal retirement age is 65. The biggest significance of that is that if you retire before 65, you have the ability to defer your pension commencement as late as age 65. If you retire after age 65, you have to take your pension pretty much immediately. And there could be some good arguments to defer your pension if you're able to, if you have age penalties, meaning if you're under age 60 in most cases. Most people fall on that age penalty column on the age penalty table. And also if interest rates are falling, now you can wait to take your lump sum, and if interest rates are falling, you're going to walk away with a better lump sum. Because there's a look back period, which we'll talk about in a moment, this can allow you to time the commencement decision to have a much better lump sum calculation, and we'll go through some examples on that. So what are these options? Well, the single life annuity is going to be the highest annuity payout option, but it's only good for one lifetime. You, the Chevron employee, as long as you live, Chevron, based on their full faith and credit, guarantees that you will have a paycheck. Of course, if Chevron goes out of business, you might receive some reductions to that. There is PBGC insurance, which stands for Pension Benefit Guarantee Corporation. So it's relatively secure. And we see this most attractive to folks that typically don't have beneficiaries that they're concerned about. They might be single, maybe they don't have kids. Oftentimes they have longevity. whether longevity in their family. Usually they're pretty healthy when they leave the company, no concerns that they won't live to a normal life expectancy. And oftentimes they are either very conservative, they don't like to see the fluctuations on their investments, or at least want to have a piece of their portfolio that they know is going to be coming in every month for the rest of their life, or just don't want to make decisions. This is the lowest decision option, I would say, taking the annuity, because you just get a paycheck for life. There's no investment decisions, and you may not even need to develop a relationship with a financial advisory firm, although that might be something that you can work with somebody on your 401k with, is how to invest that to produce income to supplement your annuity. One of the biggest risks that I personally see, as well as the people that I've worked with on this, is the risk of inflation, because not just the single life annuity, all the annuity options do not receive a cost of living adjustment. As a result of this, the higher inflation goes, the less valuable your annuity is going to become, or the less goods and services it will buy you. So we don't know what inflation will be in the future. That is a risk of taking your pension as an annuity. Some of the other concerns people have that I talk to, one of the reasons they take the lump sum, in other words, is if they do have beneficiaries that they prefer to leave the money to, if they don't spend all this money, rather than Chevron just keeping the unspent money. If, for example, you suffer an untimely death, that's a concern for a lot of people. And just not having the flexibility to control your income, being on a fixed income stream, you can't be as tax efficient in many cases. For example, if you take the annuity from Chevron but go back to work and don't need that income, you probably wouldn't want to pay taxes on that money you didn't need, and the lump sum allows you to defer taxes on that money, whereas the annuity, if you take the pension right away, it's going to be taxable income that you might otherwise not want. Now, the joint survivor annuity, similar to the single life annuity, it's good for your lifetime as well as one other individual, typically a spouse, but not always. And there's a variety of different options within the joint survivor annuity to take. The most common being the 100% survivor, the 75% survivor, and the 50% survivor. What that percentage determines is the amount that your survivor will get after your lifetime. So for example, if you take the 100% joint survivor, your survivor will get the exact same paycheck that you were during your lifetime as the retiree. However, there's a cost to that. The 100% joint survivor is the most expensive and otherwise the lowest benefit amount of all the joint survivor options, because it has the best death benefit. The 50% joint survivor, on the other hand, is going to be more money than the 100%. However, your joint annuitant, maybe your surviving spouse, is going to receive a 50% reduction on their benefit after you pass away. So which option you take is usually going to be a function of, in part, your risk tolerance, but also the income sources that you have in your family, whether or not your spouse has a pension, and how good that pension is relative to your Chevron pension, whether or not they qualify for Social Security, your propensity to work after you leave, as well as their propensity to work after you leave Chevron. Something else that a lot of people don't realize is that this has a potential pop-up provision. What that means is that if your spouse or your joint annuitant suffers a death early in your retirement, within 5 years of you leaving Chevron, Chevron's actually going to increase your pension amount. Potentially, if they passed away immediately after your retirement, they would increase that back all the way up to your single life annuity. And the amount declines every year until year 5 after your retirement. The joint survivor annuity no longer has a pop-up provision. So this is unique to a lot of plans, but it's not free. It is built into your joint survivor payout. So you're paying for it. In other words, it's going to create a lower joint and survivor annuity because there's a little bit of insurance in that first 5 years after you leave the company. Now, the lump sum option has been popular for a long time, even in this higher interest rate environment that we're in, where lump sums are lower than they were 4 or 5 years ago when interest rates were quite a bit lower. Lump sums don't come down quite a bit. However, I still see a lot of people attracted to the lump sum for a number of reasons. We talked about the ability to hedge against the risk of inflation in the future, the ability to grow your money, which you may or may not be attracted to depending on your risk tolerance and your comfort level with investing money. The death benefit flexibility to leave the money to children, grandchildren, spouse more flexibly, or even causes. If you don't have any individual beneficiaries, but maybe there's a charity, your church, or some cause that are important to you, the lump sum is likely going to be a better death benefit for you than the annuity options. So there's just a lot of different merits to the lump sum compared to the annuity, but the annuity, the various annuity options work out in a lot of cases. So what we recommend is comparing the two through a cash flow analysis, which is a exercise that we go through on a complimentary basis. Whether even if you're not a client yet, that's something we want to spend some time with you on. And all we ask in return, if you get some value out of that, is help us grow our business by referring us to some of your coworkers before you leave Chevron. But it is probably the biggest decision people face when they leave the company, how to take their pension, and it is irrevocable. There's no changing your mind once you get that election in and start taking your pension. So we want to spend some time on what's likely, with the highest degree of certainty, going to create the most money for you and your family during your lifetime and the least risk of running out of money. Now, I often get asked, why, when interest rates go up, does my lump sum go down? And it's very similar to a mortgage payment, which is based on a present value calculation. If you have the same amount of money that you can afford or budget for a mortgage, in this case $19.50 per month, you can afford to spend on a mortgage. It's a 30-year fixed. Interest rates are at 4% for 30-year fixed. The bank might offer to lend you $408,500 for that 30-year fixed mortgage. Well, if interest rates dropped 1% to 3% and nothing has changed to the amount of mortgage you can afford, the amount of house you can afford now just went up because interest rates are lower. This is why when interest rates went up the last few years, a lot of people that used to be able to afford a home are no longer in the home buyer's market because the amount of home they can afford is no longer one that they are interested in buying. So very similar to that, because your annuity might last around 30 years depending on your life expectancy when you leave Chevron. That annuity is fixed, but what's not fixed is your life expectancy and interest rates. When interest rates go up, your lump sum is going to go down. And similarly, when your life expectancy goes down, your lump sum goes down. So if you're somebody who's already age 60, you've already aged out of the penalties, and you leave the company but don't take your pension, if interest rates stay flat, the only variable there is your life expectancy, and as you get older, your lump sum starts to go down. The company doesn't have to give you as much money the older you are because they figure that you would have fewer annuity payments. So this is something that is overlooked by a lot of people, the life expectancy component of the lump sum calculation. And a reason that a lot of people take their lump sum right away when they leave the company, not only to avoid losing money based on a shortened life expectancy, but also to reinvest that money as quickly as possible. Even in a safe environment, today you can earn about 4% in things like CDs and money market accounts. And what most people do is diversify that lump sum into a variety of different asset classes like stocks, bonds, real estate, alternatives, and probably still some safe investments like money market and CDs. But the rate of return that you expect is going to determine the timing of when you take your pension, as well as what interest rates are doing. So we have an example here. I believe this is an actual client, date of birth, October of 1965. Their benefit commencement date in this example was June 1st, 2025. And their age at commencement, so when they took their pension, 59 years old and 7 months. This person had just over 31 years of benefit accrual service, which is calculated on a monthly basis. They had a Social Security PIA, or a projected Social Security benefit of $2,405 a month. We did a webinar last week on the significance of this because oftentimes Chevron miscalculates your Social Security benefit, and if you could prove it to them and it's to your advantage, they will actually increase your lump sum and annuity options. If you prove it to them and it's not to your advantage, they will also reduce those things. So this is something we help people with that are leaving the company, evaluate whether or not to turn in your Social Security statement. Let us know if you're not sure how this works or would like some help with this. These interest rates, these are old interest rates. You could probably tell by looking at them. They're less than 3%. Today, they're closer to 5%. We'll see that in a moment. The three corporate bond segment rates were 1.95, 2.91, and 3.54 in this example. And their highest average earnings, or their annual pay toward the end of their career, was just under $200,000. So this produced a lump sum for them of $1,525,000 and some change, as well as a single life annuity of $73.57 a month, roughly. Now, same individual, all we changed here was when they take their pension. So their retirement date stayed the same, but they deferred the election of their pension by 6 months. So a couple things happened. This person aged out of the penalties because in the first example, they were under age 60, so they had some age penalties. Now they are 60 years and 1 month on this second example, no age penalties, which helped both their pension lump sum and annuity. But something else changed was the interest rates. The interest rates are higher on all three segments, and the net impact is that their lump sum dropped by almost $17,000. Even though their lump sum increased because of the age penalties going away, it was more than offset by the increase in interest rates, resulting in $17,000 less on their lump sum. Their annuity did go up a little bit because of the age penalties going away, but the interest rates did not impact their annuity calculation. I'm going to zoom into the interest rate table here. The way that Chevron calculates your lump sum is by using the corporate bond interest rates. The first, second, and third segment rate are dependent on short, intermediate, and long-term corporate bond interest rates. And the IRS publishes these rates monthly, usually about the 20th through the 25th of the following month. So we have data available through January of 2025. And if we use January, December, and November interest rates, we can now predict officially what the April benefit commencement date lump sums will be. And that gives us a bit of a crystal ball to say, if interest rates are going down, I might defer the election of my pension by another month. And we continue to play the interest rate game and watch this on a monthly basis to maximize what we walk away with. If interest rates are flat or going up, that could be a reason to take your pension as quickly as you possibly can to avoid losing money on your lump sum, as well as have the ability to reinvest that money as quickly as possible, because there is an opportunity cost of leaving that money in the plan, even if interest rates are staying flat. You can see interest rates popped up quite a bit, and I will highlight that the second segment rate carries by far the most weight in this calculation compared to the other two. For example, it's 3 times more relevant in the calculation than the first segment rate. So we watched this the closest, and that one went up, looks like 27 basis points from December to January. Now, of course, January is only 1/3 of the calculation, but that's a pretty big increase from month to month. And ideally, we see rates falling leading up to your commencement of your pension. And this is likely to be something that we're going to be working with our clients that go with us after leaving Chevron this year, is picking the best possible month to take their pension, to walk away with the most money, as well as get access to that money. Something else has happened in the last few weeks. The market has dropped, as measured by the S&P 500, pretty substantially, close to 10%. This is a good thing for people that are gaining access to their lump sum money, because now stocks are cheaper than they were a month ago. Now, who knows what's going to happen the rest of this year, but of course, that's a negative impact on your 401k. But all else held equal, now investments that you were probably going to invest in anyway with a portion of your lump sum just got less expensive, and that is a good thing, as long as you are confident eventually those stocks will recover, and you're being very considerate of what actual stocks you're buying, not buying too aggressive of stocks, not buying expensive stocks, looking for good value on the investments that you're purchasing, potentially with a portion of that lump sum. This is something that we, of course, would help you with if you were a client of ours. Now, some other sources of potential income, especially for those of you that aren't yet 59 and a half and plan to go back to work, but maybe don't get a job within a year of leaving Chevron, or by the time your severance money has been exhausted. The best one is post 55 withdrawals from your 401k, in my opinion. Now, to qualify for this, you have to leave the company on or after the year you turn 55. So you could even be 54 right now and when you leave Chevron, but turn 55 in December and still qualify for this rule. What this allows you to do is take penalty-free withdrawals from your Chevron ESIP plan, your 401k. And the way that Chevron observes this through your summary plan description is that they allow for partial withdrawals once every 30 calendar days from your 401k, which is flexible enough for most people who are looking to create some penalty-free income who aren't yet 59 and a half. Now, if you don't qualify for this rule, maybe you were 53 or younger prior to leaving the company, 72T is another option in the IRS code where you can get penalty-free money from your pension and 401k, even though you're not yet 59 and a half. What this is helping you avoid is the 10% early withdrawal penalty that gets added on to both the federal taxes as well as the potential state taxes, depending on which state you reside in when pulling this money from your retirement account. Now, 72T is pretty strict and not very flexible. It requires you to take that same withdrawal that was calculated, and you can be flexible on how much you withdraw and set this up for. You can't exceed the IRS maximum, which for a lot of people isn't enough income, and this might only be a supplement to another job's income or maybe your spouse's income or some other options. But once you lock this in, you have to keep that income coming out of your retirement account for at least 5 years or until age 59 and a half, whichever is a longer period of time. And that's not ideal, especially for people that maybe you do get a job 2 years after you leave Chevron. Now you have this extra income that you don't want because you don't want the extra taxes on it. So before entering into an arrangement like this, we do a lot of due diligence to make sure it makes sense, because the detriment to blowing up one of these 72T arrangements is that you're going to pay penalties on every dollar you ever took out during the time that you were taking out money under this 72T schedule. But it works out for a lot of people. One of my Chevron guys in Midland that retired under the last EOI, he did this for 3 years. I think he was only 53 when he took that offer. He ended up going back to work for Chevron as a contractor, actually. And so this income wasn't ideal for him, but we ended up offsetting it by more 401k contributions in his wife's account to get a better deduction to offset some of this 72T income. Lines of credit, whether it's a home equity line or some other type of line of credit, could be a way to bridge the gap between your severance running out from the EOI and the next job that you take after Chevron, or 59 and a half for those of you that are just trying to make it 59 and a half to have more flexibility to get penalty-free income from your accounts. And then any after-tax accounts, you have money saved up in your bank, non-qualified brokerage account, your LTIPs would also fall into this category if you qualify for those. These could all be sources of capital to mitigate the taxes and bridge you to either 59 and a half or to that next job if you plan to work after Chevron. Unfortunately, statistically, we found that 74% of Americans over the age of 50 don't even have a written plan for their retirement. And as far as we're concerned, this is unacceptable, folks. There's a variety of companies out there that will do this for you on a complimentary basis, including ours. We're happy to do this for you for free. Whether or not you're a client of ours, we hope that we get an opportunity to earn your business, but there's certainly no expectation of that. Even if you already have an advisor, maybe you plan on doing everything on your own, we're still happy to go through this exercise with you because we know that you probably know some people that would benefit from talking to us. And that's how we've grown our business over the last 30 years is by asking for referrals from the people that we've helped, our clients, and even the folks that didn't become clients. We're delighted to spend some time with you folks. We're very confident that we are qualified to help you make good decisions upon your transition from Chevron. And all we ask is that you help us grow our business if you find value in that exercise. So let us know if you'd like to take advantage of that cash flow analysis, or if you just want to spend a few minutes on the phone or in person on a web meeting even, talking through some of these decisions that you have to make when you transition from the company, or just a couple questions, ask away. You can email us at info@theretirementgroup.com. You could call us at 800-900-5867. You can even pull up this QR code on your smartphone to get on mine or one of my colleagues' calendars who is familiar with the Chevron plans and is willing to spend some time with you. We're trying to be as available as possible through this high demand time when a lot of people are revisiting their retirement plans from Chevron. We also have a LinkedIn page where we publish these webinars, many specific to the Chevron benefits, some generic to estate planning, tax planning, our investment philosophy and what's going on in the markets. A lot of great retirement strategies on there. So if you have a LinkedIn account, you could follow us on LinkedIn and get updates on what we think is some very relevant content related to folks transitioning out of Chevron. So with that, we're going to wrap it up today. We appreciate everybody's time today. Let us know how we can help folks. We hope to talk to you very soon.